Hi, I'm Eric.
And I'm Dick. We're the Annuity guys.
And we're going to examine today whether or not, fixed annuity rates, well, do they really beat bank interest rates?
You know, Eric, to set the stage for that a little bit, we've got a nomination coming up here of Janet Yellen.
So we're throwing Uncle Ben away and bringing in
Aunt new Federal Reserve Chairman. Yeah. And so I think that we have to talk about where interest rates have been and where I think that they're going to go, and then answer that question.
Well, and that's my general belief, and I'll just start with, typically you see annuities are paying a higher return than banks.
Well, historically.
Just
so
if CDs are here.
Yes.
Traditionally, annuities are going to pay somewhat higher.
But right now, the savers,
yes.
the retirees, the folks that have been diligent in putting their money away, preparing for this time in their life.
Welcome to the penalty box. You no longer are being treated like royalty.
So we've got this upside down world now where you've done everything right, and now you get penalized with very, very low interest rates, and it would appearances that we're building a nice bubble up into the stock market and just the various securities where that money's flowing instead of into savings. Naturally, who would want to put money in a bank account that's getting
zero?
Half a percent, 1%.
And people don't really think about it in this terms, but when you put money into a CD or a money market account, you're actually losing money because the effect of inflation is actually eroding what's there. Your spending power is decreasing every year as you let it sit
and
there.
Folks that would maybe otherwise not put money in the market, they have no place to put their money that it can earn anything, so they'll maybe take more chances and go a securities route. And that's where we do find a lot of folks will turn to annuities, again looking for, hey, what's got at least some comparison in terms of safety, but gets a better interest rate.
Well, in part of there's a misnomer a little bit about fixed annuity rates, because a lot of times, it's going back to the term fixed, they tend to think the annuity rate is the same every year when they start.
Yes.
It's not necessarily always that case. So your first year rate is fixed, and then the insurance company comes back to you the next year with another year fixed rate. Now, those rates can change. Now, in a rate environment where you're already at all-time lows, would it be advantageous to, say, select an annuity where the rates could actually...
Where you get a good initial rate, we'll call it a teaser rate or, an introduction rate.
Bonus!
But the idea that your rates could increase, that does have an attraction to some. And then to others... they want that concrete, that absolute guarantee that if I put my money in here, I'm going to at least get X, Y, Z. And that would be the CD style or the multi-year guarantee annuity.
And that's what the nice thing is, annuities have that flexibility of saying, hey, if you want that same rate guarantee over a period of time, that's an option. If you think that interest rates are going to come up, and you just don't have another place to go, well, here's a place where you can park money and get a market return each year based off of what the company is willing to offer, based off the market conditions.
Yes.
So it can go up, but then conversely, can also go down.
Well, and back to what we'd started with originally, discussing where rates are going, with Janet Yellen, being the nominee for the Federal Reserve Chairman to replace Ben Bernanke. The concern is that she has a lot of the same strategies and thoughts. She's going to follow that same line of pumping a lot of money into the economy, artificially holding rates down, trying to pump up employment. And this is the biggest experiment we've ever done with monetary policy on this level that could really backfire on us in a big way. But it does appear it's going to hold rates down for a long time.
Well, and I think the statement that's been made by the Fed that says, hey, until we get to an unemployment level of 6.5, below that level, we're going to keep rates where they're at. Well,
that could be a long, long time.
And so when people, and we've talked to these people consistently, they're on the sideline. They're parked in cash. They're parked in 0% basically returns because they expect rates to go up. they just can't foresee this poor rate environment lasting. But we've got people that are basically in charge of our rates telling us they're going to keep them here until we get to this.
And Eric, this is why it does make sense, I believe, just financially, just doing the simple math, that if you keep money parked at 0.5%, and you've got the opportunity to earn 3% or 3.5% or something of that nature, by putting it in a shorter term type of an annuity, and then you've made all those gains for the next year or 2, 3 years before the rates tend to go back up. So now, if they do go up a little bit higher than your 3.5%, at least you didn't lose anything during those. You've had your money working,
right?
And so there's just that nice offset to getting your money working today, and then knowing that you can still do something later.
Well, and I'm a big fan of laddering. I mean, I've talked about laddering. In fact, I talk about laddering MYGAs in the terms of multi-year guarantee annuities. We've got decent rates at 5, 6, 7%. Well, or 5, 6, 7 years. Percent would be really.
I was waiting where you were going with that one.
but looking at those,
yes,
by staggering those terms, so you have money becoming available. You may take some shorter terms now, but always having kind of that circular nature. Rates when they change are not just going to be. It's not just like flipping a switch and all of a sudden they'll be 5% tomorrow.
Right.
You're going to see gradual changes. It's best to get money in a place right now where you're getting at least a competitive return of to combat inflation, and having that ability to kind of just keep recycling those ladders as they come available. So
I agree, and a lot of folks have done that for many years with CDs and other types of banking instruments, and so using them with annuities shouldn't be anything unusual. And right now, it is a fact that annuities are considerably higher than bank rates, and there are some shorter term annuities that give you a little more flexibility in the event that the rates do eventually, take off.
Yeah, and I mean, I think I looked at the average 5-year CD, before we started, and we're at 1.3 is the average.
Yes,
it's not there's hires and lows.
Yes, and we've seen recently 3.5% on 5-year annuity.
Yeah,
so
exactly, MYGA style. So
right.
So there are better options available
than the banks,
in my opinion.
Thank you.